Live from Singapore, this is Insight with me, Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. Hopes for a December Fed rate cut are fading as markets also brace for President Trump's return. His much-touted lower taxes and higher tariffs are expected to usher in quicker inflation and a tighter Fed. As Treasuries wipe out most of the gains for 2024, we will be joined by a leading bond fund manager, Charlie Jamieson, CIO of Jamieson, Coote Bonds, joins us in just a few minutes. And shares of several Asian aluminum stocks surge while their Chinese counterparts melt away after Beijing says it would cancel a tax rebate that helped drive a boom in exports. We get a reaction from one of the world's top aluminum companies, Satish, the MD of India's Hindalco, which also owns Novelis, joins us for an exclusive interview. Well, markets reassessing pretty much what Fed's trajectory will be like. We have swaps pricing in a 40% chance of a rate cut in December. Remember that markets were pretty sure we'll see that rate cut in December, but no longer, thanks to resilient eco data. Of course, expectations of Trump policies which are likely to be inflationary. Taking a look where we are in terms of 10-year yields, 443.35. Remember, we saw 4.5% just on Friday, a record high. Expectations are that we might just see yields surging past that 5 mark. Treasuries seeing that 2024 gains dwindle with that December Fed rate cut pretty much at risk. Now, we also heard from Boston Fed President Susan Collins as well as Chicago Fed President Austin Goolsbee on their rate cut outlook.
I think we're well positioned. I certainly wouldn't take another ease in December off the table. But again, we're not on a preset path. And so we'll have to look carefully at the data and see what makes sense when we get to December 18th.
I think we're going to be looking at rates coming down over the next year along the lines of what the dot plot said. So I still think we have a long way to go down with rates. There's some dispute about what is the neutral rate at which we're going to settle down. If there's disagreement about that we don't just charge right to it, that we slow the pace as we get toward it.
Well, our guest expects lower risk appetite and says he's keeping strategies, quote, nimble. Let's bring in Charlie Jamieson, CIO of Jamieson Coote Bonds, a privately owned high-grade bond manager. Good to have you with us. It does seem like investors are back to the drawing block. There's so much uncertainty. Well, expectations are we might just see, questions about whether or not we'll see that rate cut in December.
Yeah, obviously the markets have repriced significantly in the last 6 weeks. With the red sweep and the Trump victory, the expectation is that animal spirits can be released. Certainly the policy combinations are still unknown in full, but the expectation is that they will be economically friendly and there can be a lot of money spent potentially. But this is where those combinations come into question, because Trump and his team have also suggested they want to find those efficiencies which will be led by Elon Musk, and that could certainly take some growth out of the market. So what we're experiencing at the moment is the market's chopping around in a volatile range after the election, but certainly data dependency in what is still relatively volatile data will be the leading light into the December Fed meeting.
Well, the struggle continues. We know that the bond market is struggling to find the North Star. We saw yields going to 4.5%. Some say those 10-year yields will get to in excess of 5%. What are you anticipating?
We don't think, of course they can get to 5%. We don't think they'd stay there very long should that occur. But in the wrong combination of outcomes, they may have an accelerated sell-off, which could get us there. We certainly saw that pretty much last year and then rallied back very quickly. The reason being is that starts to take the wind out of things like the equity market. That becomes too restrictive in the economy. But clearly this question around the budget sustainability in the United States and what really are the spending intentions of the Trump government. We've seen these moments where Liz Truss in the UK lost the confidence of the bond market, and the bond market taught that administration a very swift lesson. So I do think that the incoming administration will be very conscious of this, and they need to find that combination of policies that allows for some efficiency to be delivered, but doesn't change the growth trajectory, which obviously the economy is enjoying at the moment.
Charlie, you talk about the Liz Truss moment. We know that bond vigilantes have been awakened. How do you position in this type of scenario?
Look, I think that the markets want to be positioned in a curve steepening structure. They know that the Fed has continuously made comment that they want to bring the Fed funds rate back towards neutral. There is, of course, great debate about what that number actually is. Is it 2.5? Is it 3? Is it 3.5? Clearly, we're still well above that. So we can expect more rate cuts, and we had commentary over the weekend to suggest that's still primarily their expectation, although they are data dependent. But clearly, if we are to have that moment where questions are raised about the sustainability of the budget deficit and the debt obligations, then the long end and those longer yields can certainly sell off, and that would steepen the curve. So I still think that's a favoured structure of the markets. We're very sympathetic to that. Albeit the curve has flattened a lot recently as we've been pricing out some rate cut expectations from the Fed. I guess we've got to expect that softer data will accelerate under Trump. There could be a lot of purchasing activity ahead of potential tariffs. So in the very near term, it's very likely that economic activity actually accelerates just before the inauguration in January, people racing to get set before those policy changes may or may not come to market.
Charlie, you can only imagine emerging market bonds will be under tremendous pressure from here.
Yeah, look, absolutely. I mean, certainly, the world over, depending on the combination of policies that are actually implemented, there can be great pressure on emerging markets, on Europe, on Asia. And so certainly, depending what the level of those tariffs might be, it's very difficult to ascertain exactly what that will look like at this stage because the policy detail is scant. We know roughly what the campaign policies were. We do expect that they'll be implemented, and certainly what seems to be occurring as appointments are being made at the moment looks like Trump is very much keeping his word with regard to the campaign policies. But as I said, those combinations of policies need to be well thought through because if we are to take a huge amount of US government spending out of the economy right now, well, that could tip the economy into a negative growth situation quite quickly. So whilst those efficiencies are found, there needs to be substitutions, there needs to be that animal spirit, there needs to be the rise from the private sector to make sure that this all stays in balance if we're to fund ongoing corporate tax cuts, potentially personal tax cuts, and some of these initiatives that Trump's been so adamant about bringing to market.
Right. And speaking of appointments, Charlie, of course, front and center, that Treasury position. We have Elon Musk weighing in. He likes Lutnick. I mean, does it matter who takes up that position? How are you looking at it?
Yeah, I think it does matter, absolutely. The markets are probably favouring Besson at this stage. Lutnick's, again, very well credentialed. Just this morning, there's two other names that have been raised in Kevin Walsh and Cowan, I believe, from Apollo. Look, these are all very well credentialed people. They've had a lot of experience in financial markets. But this is a critical role at a time where when these policies come to market, the market needs to have confidence that the Treasury curve and the financing obligations can be delivered in a way that doesn't unsettle the status quo. And certainly, that combination between very short-dated issuance using the T-bill program versus the longer-dated coupon issuance needs to be very well considered. And so I do think it does matter who has that role. I think that the candidates all look very well qualified, but I think the markets would probably favour Besson at this point, but we'll wait and see how Trump makes that decision.
You said it. We'll wait and see, Charlie. Thank you so much. Charlie Jamieson, CIO of Jamieson Coote Bonds. Well, Coming up, an exclusive interview with metals giant Hindalco Industries. We'll be joined by Managing Director Satish to discuss their outlook for aluminum prices after China scraps a tax rebate on aluminum exports. Keep it here with us. This is Bloomberg. Welcome back to Inside. Now, shares of aluminum stocks in China fall while other Asian players track the metal higher after China said it would cancel a tax rebate that's helped drive a boom in exports. Aluminum futures in London had jumped as much as 8.5% on Friday following that announcement. The tax rebate, which was staggered up to 13%, was also removed for copper. Well, for more, let's bring in Bloomberg's Manika Doshi in Mumbai. Manika.
Hi, good morning, Haslinda. This is interesting news coming in from China. Definitely will have a large impact on the metals industry, specifically aluminum and copper. But more importantly, we're also watching out for what eventually will be the outcome of any additional tariffs that the new Trump administration will impose on this industry. And the best person to give us an overview of how to prepare for this is the managing director of Hindalco, one of the world's largest aluminum and copper companies. Satish joins us this morning. Satish, thank you so much for your time. Let's start by getting your response to what you think the impact will be of the scrapping of that China export tax rebate on both aluminum and copper products.
So as it took us quite a little bit by surprise on Friday, because as you said, it really what it does is make Chinese exports not that competitive. So it's quite surprising to see what China has done. It could be a sign of confidence in their own internal demand, or it could be, expecting some of the trade tariffs, etc., that the US may put on. But it certainly has jolted the metals market. So we'll have to wait a little bit and see, but it does make Chinese exports more uncompetitive and frankly makes for players like us, we should be in a better place with this because we will have less lower cost Chinese imports to fight against.
Well, absolutely. Satish, any immediate benefit that you see taking place over the course of the next quarter or two, or even three, given that Chinese imports of both aluminum and copper have been a concern for you here in India, which is your strongest demand market right now? The US hasn't been as much. I'd also like you to give us an overview of how you're preparing for a second round of tariffs from the new Trump administration.
So first thing I want to say is that, our biggest market for our international subsidiary, Novelis, is the US. And in the US, most of the production is for the US market. So the coming administration, we think, is going to be broadly positive for Novelis US, which is the largest part of our Novelis business internationally. Now, I think when it comes to India's point of view, as you rightfully pointed out, what we were more worried is that if US tariffs go up, will Chinese exports come and flood the Indian market? Now, this announcement on Friday, reducing that export rebate, means that for them to come into the Indian market, it's not going to be that easy anymore. So I think that, again, we'll have to wait and watch what is really going to happen. But at this stage, both the new US administration as well as the Chinese government's move to cut the export rebate that they gave is broadly positive for Hindalco and Novelis.
Satish, you talk about how Hindalco may benefit. Can you quantify the kind of benefits? I mean, how are you positioning, Hindalco to capitalize on the move made by China?
So look, we have spent the last 5 years expanding our India capacity from 300,000 tons to 600,000 tons. So I think for us, the Indian market is growing at about 7 to 8% CAGR. Quarter on quarter, as we were looking at, it's even in the double digits. So for us, if Chinese imports do not come in at a low cost to India, it's really going to be very positive in India because the electrification sector is growing at double digits. The packaging sector is growing at double digits. The building and construction sector is very stable. So the Indian market is very buoyant for metals, both aluminum and copper. So I think that, that's why we believe that we are ideally poised to take benefit of this.
Satish, on a longer-term basis, how do you see this shaping the global trade dynamics? How might this play out in the longer term?
So I think that, really what was happening is that China was exporting about 6 to 7 million tons of aluminum products. The Chinese government used to disincentivize selling of primary out of China and try to incentivize value-added downstream products. By taking away this tax, in some ways, the Chinese government has leveled the playing field with all the players in the market. So it's really interesting. I mean, I can only interpret it as a sign of confidence that they believe the domestic demand will be good enough, which, by the way, is very positive for aluminum and copper prices.
Are you seeing numbers that suggest that the domestic demand in China is good enough? Or do you see this as a politically preemptive move by a government that is aware that it's likely to face, a fairly hostile US over the course of the next several years?
Yeah, I think that, the implications of what is happening in the administrations is more difficult to sort of speculate on. But let me just go to your fundamental question. Is the Chinese demand strong enough? All through last year, the demand has been quite robust. In fact, China is in a 1 million ton deficit of aluminum right now. So I think that, whereas it's not growing at the rate in the past, I would say that the electrification sector, the new energy sector driven by solar and EVs, the only sector in China that is weak is the building and construction, but the other sectors are doing quite well.
Satish, I must ask you about your capital expenditure plan or your future investment plan, so to speak. You already have, a $4 billion expansion underway at Bay Minette. And I think, if I understand correctly, you've announced another $4 to $5 billion in investments in India over the course of the next 3 to 4 years. Now, so talk us through what you're seeing as the potential demand over the course of the next 3 or 5 years, and how this changes, if at all we see surprises on the trade tariff front.
So I think that what is very clear from the fundamentals is that the demand for aluminum and copper is growing at a fairly robust rate, and India is growing at 7 to 8%. So what we are doing is that we are going to spend 4 to 5 billion putting a brownfield aluminum smelter expansion, a brownfield copper smelter expansion, an alumina refinery, and a copper recycling plant, roughly $1 billion each. So 4 billion in just 4 projects. So overall, a capex outlay of 4 to 5 billion. And that's largely dependent on the strength and the growth of the Indian domestic market. So for us, we have a clean balance sheet that allows us to do these big projects. Most of them are brownfield, so that the risk of implementation is slightly less because we already have the land and the clearances. So the next 3 to 4 years, we are very excited to do all these upstream projects expansion.
Satish, you talk about how you're optimistic about demand. Talk to us about your own price projections for aluminum as well as copper. Perhaps in the next 6 months, where do you see copper prices and aluminum prices headed?
This has become an increasingly more difficult thing to predict because the volatility is amazing. I mean, the aluminum prices can swing up and down $100, $150 in a couple of days. I think that, the part that I always maintain is that supply and demand for aluminum is tight. So these pricing and these fluctuations are not driven by the supply and demand. It's more driven by geopolitical and other events that sort of move the prices. So I believe that we are going to see a new baseline for aluminum prices. And the things that are driving it is, yes, tariffs and geopolitical events, but you also have to realize that alumina prices are at an all-time high now, trading at over $700 a ton. So that also gives a push up to the aluminum prices. So in the short term, I think you're going to see aluminum prices around the 2,500 range, if not higher.
It's also about critical minerals. We know that India wants to cut its dependence on China when it comes to critical minerals. And we know Hindalco as well is looking to bid for sites, mining sites. Where are you with that?
So I think, as you rightfully said, we are now working on quite a few critical minerals. We are setting up a pilot plant to extract gallium from bauxite residue. We are also extracting vanadium from bauxite residue. So we always did that, but we have really stepped up the efforts. So we are bidding on nickel and cobalt mines. We have got one mine as an exploration license already in India. So I think what you're going to see is Indian companies getting a lot more into exploration for these critical minerals. I also wanted to tell you that our recycling project for copper is also going to recycle electronic waste, printed circuit boards, which also give you quite a lot of rare earths and critical minerals. So as a part of recycling, which we call urban mining, as well as doing exploration on the ground, I think Hindalco is going to try to get as much as we can for rare earths and critical minerals.
A quick two-part question from me, Satish, on this, following up on what Haslinda asked you about rare earths. Can you give us a sense of what more you might have in the pipeline in terms of potential mines you might be bidding for? That's part one. But secondly, your business is centered around recycling and also a vast number of sustainability initiatives. There does seem to be some expectation that with the new administration in the US, there might be a de-emphasis on climate. Does that change the way you do, the way you do business in any fashion?
No, I think that, the whole purpose and the ethos of Hindalco has always been centered around ESG and sustainability. So I think that what we do when it comes to waste, water, emissions, I don't think it's going to change on a year-to-year basis. I think you must have seen that we have now been rated for the 5th consecutive year the most sustainable aluminum company in the world by the DJSI ranking. So I don't think that short-term events are going to change our direction when it comes to ESG.
Any plans for acquisitions when it comes to... Go ahead, Monica.
You stole the words out of my mouth. Please finish it.
Yeah, any plans for acquisitions?
So I think we keep looking now more and more in the other minerals, as you rightfully said. So we are not looking straight at aluminium and copper because our size makes it very difficult. But we are looking at the other critical minerals, whether it's nickel, cobalt, titanium, any of the others, if there are any opportunities out there. So, and as Monica said, we are also very focused on trying to expand our recycling footprint. So that is another space that has opened up, and we'll be looking at companies that are in the recycling space.
All right, we'll keep an eye for that. Satish Pai, Managing Director at Hindalco Industries, and of course, Bloomberg's very own Monica Doshi. Thank you so much for that. In the markets, let's take a look at how Asian benchmarks are doing, reversing earlier losses now in positive territory. We're seeing strong gains in Hong Kong as well as in China. Never mind that it's hard to predict why that is happening at this point in time. We have HSI up about 1.5%, CSI 300 index up by about 1%. In terms of the benchmark, in Korea, strong gains as well, up by 2% as we speak. And in the FX space, it has been a strong dollar policy, putting a lot of pressure on Asian currencies. Let's take a look at how the yen in particular is trading, 154.79. That dollar strength putting a lot of pressure on the Japanese yen. People talking about it going to 160. Keep an eye on the movements there. Still to come, Hong Kong and mainland China marks 10 years since the launch of the Stock Connect program, with investors eyeing deeper access. We'll hear from the Hong Kong Exchange CEO next. Keep it here with us. This is Bloomberg. Well, Welcome back. You're watching Insight. Well, Chinese equities are in focus as President Xi Jinping spells out his approach to ties with the U.S. as we await the return of Donald Trump as president. Bloomberg's Evil Hong takes a look, and you know what? We're seeing strong gains right now.
Yeah, it's so interesting how on a day where there's nothing much in the way of positive catalysts for Chinese stocks, look at the way they're performing after steep losses just last week. And to your point, I think this is part of how the Chinese president has outlined his approach to the U.S., offering an olive branch of sorts to President-elect Trump. That's a bit of a mood lifter, lifting sentiment on Chinese equities. We have Morgan Stanley turning bearish on Chinese stocks, though slightly underway in the context of Asia ex-Japan, citing deflationary pressure, citing geopolitics, and it doesn't think that authorities are going to be front-loading enough fiscal stimulus next year. It's also, by the way, cut its price target for Alibaba's U.S.-listed shares after lackluster earnings. So this is what we're seeing today, but of course we're also looking back at the past 10 years because today the Hong Kong Stock Connect celebrates its 10-year anniversary, and it's been credited, of course, for bringing a broader swathe of international investors access to China. Over the years, we've seen mainland mutual funds that have been allowed to trade, ETFs included. Then we also have now 3,000 plus stocks that are part of the scheme. And I think most think that the next big step is IPO access, primary markets. That would be a really strong signal of deeper access. And I'll flip the board because overall, this Stock Connect has been seen as a success. You think about the billions of dollars of daily trading volumes cross-border, and you look back to the southbound net inflows in the past decade, 3.4 trillion Hong Kong dollars worth.
Wow, 10 years already, Evil Hong. Thank you. Now, Bloomberg's chief North Asia correspondent Stephen Angle also spoke with Hong Kong Exchange CEO Bonnie Chan, who still sees a lot of room for the Stock Connect program to grow.
I think we're still actually at the beginning. If you look at the volume so far, from the very beginning, southbound traffic has actually grown 50 times, and northbound traffic has also grown 25 times. And this is quite amazing. And if you ask me how we're going to continue to expand it, I'll say three ways that we're going to do it. First of all, products. We need to put more products onto the shelf. As you know, we started with stock, and then we expanded it to include bonds, ETFs. We're going to soon have REITs. But
we're waiting for that, though. Can I jump in and say there's no date yet?
Well, we're working on the details. I mean, certainly with every enhancement, we need to make sure that, you know, all the screws are tightened up. And there is still a lot of white space that we can fill in. So that's the first dimension. Secondly, the micro-infrastructure, which is very important. We need to make sure that the users of the Connect franchise have a good experience. And I think, you know, very recently we've proven that with micro-infrastructure changes, the market can be greatly enhanced. Severe weather trading, as an example. I think we've proven to the world that, you know, Hong Kong as a market has stepped up to that moment. And then third, but not, you know, the last, it's the fact that at the moment, you know, the participants, I think it's still a relatively small pool. I have been traveling a lot recently, and I would say that, you know, the Connect story is still pretty novel to a lot of our friends in the world. And so I'm going to go out there and continue to market the Connect.
So right now the conditions are not necessarily ripe. You've raised about $9 billion this year, I believe, $5.33 billion last year. So it's better than last year, but it's way off of 2020. Was it 2020? There was $53 billion or something like that. Yeah. So you have a ways to go. So again, I'm going to come back to the primary Connect. Is it on the docket for next year?
Okay, so let's talk about where we are in terms of the IPO activities. And I'm very happy to report it because last time we spoke, I think, you know, in terms of our league table ranking, we are a little bit sort of at the bottom of the top 10, shall we say. We're now number 4. And we have completed a very big IPO, my dear, which is a $4.6 billion US IPO, the second largest in the world this year, and the largest in Hong Kong since February 2021.
SF Holdings possibly too?
I think they are about to launch.
They just announced that they've been
that's certainly going, hopefully, to bring our total fundraise this year to above 10 billion US, which I understand, right? Compared to previous years, it's a little bit sort of lower. However, I think you need to look at the relative ranking. And for the rest of the world, the last 2 years have not been a particularly conducive year for IPO activities. But, I think we have reached a pivot point, and I'm certainly seeing momentum pick up.
I have to ask you, what do you think is going to be the Trump effect on the Chinese economy and how that equates to capital raising, potential action against China, and the dampening effect possibly on the market here?
Okay, I know that question will come.
Yeah.
Now, to me, what we saw is that the week leading to the U.S. presidential election, the trading volume actually softened a little bit in our market. But as soon as the election is over, we saw the volume got back up again. So I think, with the presidential elections now behind us, there is now sort of the market knows how to move on, which is a good thing. To me, this is not the first time U.S. has Trump as the president. We've gone through that. What our market has continued to prove is that, whatever the conditions are, we have that resilience to make sure that we can ride the tide. So that's the important thing.
Hong Kong Exchange CEO Bonnie Chan with Bloomberg's very own Chief North Asia correspondent Stephen Angle. Now, Chinese leader Xi Jinping used his final meeting with outgoing President Biden to send a message to his successor, Donald Trump. During the APEC summit in Peru, Xi indicated that China wants to be friends but is ready for a fight if necessary. Xi also reiterated Beijing's 4 red lines, which includes containing China's economic rise and encouraging Taiwan's independence.
Neither decoupling nor supply chain disruption is a solution. Only mutual, beneficial cooperation can lead to common development. Small yard, high fence is not what a major country should pursue. Only openness and sharing can improve the well-being of humanity.
We haven't always agreed, but our conversations have always been candid and always been frank. We have never kidded one another. We've been level with one another. I think that's vital. These conversations prevent miscalculations, and they ensure the competition between our two countries will not veer into conflict. Be competition, not conflict.
Coming up, we'll get insights on the aviation industry from the Association of Asia-Pac Airlines. Hear how companies are coping with persistent supply chain issues. That's coming up next. Keep it here with us. This is Bloomberg. Welcome back. Airlines are being forced to use older, less fuel-efficient aircraft and are experiencing longer repair times. The heads of some of Asia's biggest airlines say they're frustrated with long delays in new aircraft deliveries and spare part supplies. They blame the desire for higher profit margins and inadequate representation by industry lobby groups for the shortages. Let's get some perspective from Subhas Menon, Director General of the Association of Asia-Pacific Airlines. We're seeing some finger-pointing here. Who's at fault when it comes to these supply chain disruptions?
Well, I think the whole industry needs to work together to resolve the problem, So the demand side of the market is doing very well. The airlines are, already recording seat factors which are higher than pre-COVID. The growth in the Asia-Pacific industry is double that of the global industry, So things are auguring well, and the airlines have been putting on more capacity to meet the growing demand. So you could say airlines are flying on all cylinders, but we are still waiting for the delivery of the cylinders, So I think the manufacturers, starting with aircraft manufacturers, but also engine manufacturers, need to do something to repair the supply chain, which has been broken as a result of COVID. So many of the intermediate suppliers of various parts and components that go into making the modern aircraft and engine went bust during COVID. They lost a lot of workers, technicians, and mechanics. You need to do something to repair the supply chains so that we can get the delivery of the aircrafts that airlines have ordered on a timely basis.
Well, the question is, how much is being repaired right now? How long will the supply chain disruptions last? Some say perhaps 5 years. That's a long time.
Well, if nothing is done, yes, it will take 5 to 6 years, But what we want the manufacturers to do is to really shore up their supply chains, if you order an aircraft today, you're looking at a delivery timeline of 2030. That won't do, because the demand is growing very strongly, and we need to meet the demand, and we need the aircraft. At the same time, we're using older aircraft and older engines, and these break down more frequently, and the parts and components that go into repairing these older aircraft and engines are also not available, So it's, between the devil and the deep blue sea. So if manufacturers want to continue to make the profits that they are making from this industry, they really need to invest in their supply chains.
What does it mean for airlines? I mean, shortage of supplies is one thing, right? The other thing is also closure of airspace, given all the uncertainties in the Middle East. How is this going to play out for airlines in the end, the next 12, 24 months even?
Well, you hit the nail on the head. Those two are the primary challenges that the airlines are facing. Airspace closures, what it means is that airlines have to constantly look for new routes to fly, especially, to the West, to Europe and America. All right. I mean, they were using the Ukraine, Russian airspace for the longest time. They had to shift to the Iranian airspace because of the war there. And then because of the war in the Middle East, they have now shifted to Afghanistan. So different airspaces that they have to look. This increases travel time, also operating cost, because crew flight time limitations will be breached. So this increases cost for them, as well as other, critical factors like GPS spoofing and, interference, in radio frequencies. So safety is also a concern. So airlines, have to be very nimble and operate, and at the same time bear a lot of the higher costs.
So you're saying that margins will be squeezed, and yes. Are we then anticipating higher ticket prices? We're already seeing how prices have remained elevated. Do you see airlines having to raise prices to counter?
Actually, ticket prices have been coming down because airlines, in spite of these challenges,
well, not Singapore Airlines.
They have been reducing prices, the ticket prices. I think Singapore Airlines also announced their results recently, and the yields have been coming down. But you're right, the yields are actually higher than pre-COVID, So what is the trick? You need the supply of aircraft and the regular supply of components so that airlines can put on the capacity to meet the demand. At the moment, this is not the case. I'm afraid, I think, going into the peak season, this is going to be a challenge, for airlines to put on the necessary capacity to meet the growing demand.
Talking about growth, of course, we're seeing that growth in India. We're also seeing that merger between Air India and Vistara. Will that, I guess, influence the aviation landscape?
In India, yes, definitely. I mean, you're talking about already more than 200 aircraft with the merger, and also up to 6,000 flights a week in India and from India on international routes. So this is amazing. I mean, the Indian market is very strong, particularly because they have a very large and growing youth population. And there are so many visa-free travel arrangements concluded, especially from Southeast Asian countries. So the Indians are looking for new places to fly to, and they are prepared to go via other hubs to get to these places. But the fact that the Indian carriers are wise to this and they are adding capacity, they have ordered a lot of aircraft as well. Not only Air India, but also Indigo has ordered a lot of aircraft. So competition is really doing very well in India, and the market is very alert to the opportunities that they have. So I think the Indian market is really going to come on stream quite quickly.
But in the end, Subhas, it is really about deliveries.
Yes.
Even Indian carriers will find it hard to get their planes.
That's
How will
right.
that impinge on their growth outlook?
I think it's going to be very challenging for them, but they're not keeping quiet. The CEOs of the Indian Airlines are also banging the door of the suppliers. So really, I think we don't really have to give up hope. I think the manufacturers, we have been engaging the manufacturers, so they will come to the party, and they have to take responsibility for the issue. Right now, they are a B2B business, so they don't have to front up to consumers. The airlines have to front up to consumers. So airlines are doing the hard work, by making sure that the manufacturers deliver on their promises.
You talked about how we're approaching the holiday season. How strong is demand? People often talk about how that revenge travel is done.
Yes.
Where will demand come from? How strong is that demand?
Actually, it is no longer revenge travel. I would say it's resilient demand. People, within the Asia-Pacific region, travel is a socio-economic necessity. And people travel for business, people travel for various reasons, for work, looking for work and working in other parts of the world. At the same time, for leisure. Leisure is really booming within the Asia-Pacific region. So the demand is there. And of course, airlines need to meet the demand, and ticket prices is something that they would like to see it coming down, because you need to address the volume of demand. And this will happen only if they can get the supply moving again as it did pre-COVID.
So what kind of demand is sustainable going forward? Bearing in mind, we heard from the likes of the IMF that growth is likely to taper.
It will taper. As the market growth matures, it will taper. So right now you're talking about Asia-Pacific growth at around 36%. The global average is about 16%, so almost or more than twice the global average. I would say that in 2025 we will see about 10 to 12% demand growth, but that is still pretty strong, considering that the base is very large now.
There is a trend developing. We're seeing airlines within the region cooperating with one another, Singapore Airlines with the likes of Malaysia Airlines. How do you see that? I mean, is there logic in that trend continuing? They're supposed to be competitors, yet they're now, playing with each other.
Well, I think what we are seeing is airlines, trying to, bring more interesting travel experiences, convenience, to their customers. So this trend, is not going to result in reduced capacity. What is going to happen is that, airlines have more choice. All right. I mean, instead of taking a 8 o'clock flight, they have a choice of taking 8:15 flight and 8:13 flight to various destinations. So more choice, So it doesn't matter whether you're, for example, in the case of Jakarta, it doesn't matter whether you're flying Singapore Airlines or you're flying Garuda. You have more choice, and it also goes towards your frequent flyer membership and points.
But do those choices translate to higher prices? I mean, when there's competition between airlines, they tend to compete on price. With airlines actually working with each other, they have, I guess, greater control over those prices. Might passengers, might travelers be facing higher prices from here? Yeah,
I think the trick is to make sure that that airlines do not cut capacity. As long as they grow capacity, ticket prices will also moderate. So you have to grow capacity to keep up with the demand. At the same time, you have to improve the travel experience of customers in terms of the convenience and comfort they get by having more choice.
We're in the midst of COP29.
Yes.
I'm just wondering where the aviation sector is, when it comes to sustainability and fuel efficiency and alternative fuels for that matter.
Well, I mean, demand is doing very well, as we discussed earlier. The problem is supply, also when it comes to sustainable aviation fuel, because supply is very short. So at the assembly, what we discussed is that we should also, activate other parts of the ICAO roadmap, to net zero, which one of the main features of that ICAO roadmap was technology, and this industry is a technology-driven industry. It's come this far, and every new generation of aircraft reduces or improves fuel efficiency by 15 to 20%. So at the assembly, we discussed with the manufacturers, the possibility of introducing breakthrough technology to help us to meet our net zero targets. So it has to be a multi-pronged approach. You cannot put all your eggs in one basket and just rely on sustainable aviation fuels.
But where are you with that breakthrough technology? And realistically, when can we see, emissions really being cut significantly in the aviation sector?
I think emissions will peak just before 2030, and from 2030 onwards, it will be a down cycle. When many of these measures start to bite and help the industry to reach its net zero goals.
And what's the biggest risk for the industry? I mean, when you take a look at oil prices right now, it's tapering, which is good news for airlines generally. What do you deem as the biggest risk?
I think the risk of fuel costs is always there, because when we move to renewable energy, it is going to be more expensive than fossil fuels. So the risk is there, but I would say that is part of doing business. You have to take that into account, because if you don't do that, then the cost as a result of more emissions is going to be even greater, because sustainability or lack of it also impinges on safety. We have seen a rise in extreme weather and also turbulent events, and all of this suggests, that if you don't address the problem of sustainability, then you will have other problems which will create more cost for the airline industry.
You talk about higher costs. How much higher for the airlines? How much higher for travelers?
Well, at the moment, the minus fuel costs, the rest of the costs are still lower than pre-COVID. So that's a good sign. In spite of the fact that they are, addressing manpower issues, supply chain issues, and all that. So airlines have done a pretty good job in terms of cost control. So I don't think that itself is going to impact prices. I still believe that it's all a matter of demand and supply.
Airlines have done a good job in passing on the cost to the passengers. Subhas, good to have you with us.
Thank you.
Subhas Menon, Director General of the Association of Asia Pacific Airlines. Let's take a look at Indian markets. They've been trading for about 8 minutes now. Asia, of course, in positive territory, reversing some of those earlier losses. When it comes to India, it is a pretty mixed picture. The Sensex down about 0.1%. Nifty index also in negative territory. But when it comes to the bank index, Nifty Bank currently in positive territory, up by about 0.1%. Of course, front and center, we're taking into account the messaging from the RBI. It has said that it is confident when it comes to growth for India. It is looking at 7.2% growth for the year. We're also keeping an eye on Hindalco Industries. Of course, we spoke to the company just slightly earlier, gaining about 3.5% right now. That's on the back of China scrapping aluminum tax rebates that have driven pretty much exports. National Aluminum also surging right now, up by about 6%. Of course, in the course of our conversation, we heard earlier about how Satish is expecting aluminum prices to remain resilient, but he says it's really hard to say. It is about demand and supply. Again, Hindalco and National Aluminum currently in positive territory, saying that the new U.S. administration will be positive for Novelis. In terms of futures, U.S. futures looking like this as we speak. Of course, front and center is Fed policy. Expectations are that the Fed may be tapering its expectations of a cut in December. Swap markets pricing in a 40% possibility of a rate cut. S&P futures in positive territory, up by 0.3%. When it comes to a Dow Jones futures, currently flat, 43,547 is what we're looking at. Of course, we saw 10-year yields surging to about 4.5%. Some say it could get to 5, surpassing past 5 on the back of that as well. Now, before we go, here's a look at our guests for tomorrow. We'll get insights on the global hospitality sector with Minor International Chairman Bill Heinecke. Albright Stonebridge Group also joins us to discuss the future of U.S. and China trade ties under a second Trump presidency. Plus, Aberdeen Chairman Douglas Flint will be with us live from the HKMA Summit. That is it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.